We're going to go to Gary. I had a couple of conversations with Gary phone-wise a little bit ago, and Gary says, I guess I've never considered or heard of selling an in-the-money call on a stock. I can only see that working on something one expects to go down in price. I like selling options, but try not to put on trades that require movement. I try to be as neutral as I can be. Does the idea of selling in-the-money calls really work? Yes, it does. Let's go back to just our basic in-the-money screen. And I'll use earnings picks of the day as well, perhaps. As you saw, what is the approach for an in-the-money covered call, Gary? And we'll take Mattel. We're still here. It's that same one again. Stock's trading at 20.98. We're selling the April 17 strike call. We're agreeing to give up our shares of stock for $3.98 less than we paid for it. And we're going to collect $4.32. Okay? In an uncertain market, what does this give me? It still gives me the opportunity to make 2% return for 35 days. I might want a little bit more, that's true. But again, you want to match your trading plan. I have an 84% chance, Gary, that I am going to be assigned and earn that return to make a profit on the position. The stock can fall 21% before, 20.5% before I start losing money on the position. We still get a reasonable return, a high probability of earning that return, getting assigned, Gary, and moving on. More consistent profits, 75, 80, 85% likelihood I'm going to get assigned, earn that 1.5, 2, 2.5, maybe even 3% return if assigned without having to worry about management, without only collecting 40 cents or 50 cents with an out-of-the-money call. And if the stock drops $1, I'm now considering rolling down that call because I'm losing on the position. It's much better protection in this case, and a better probability of getting assigned and earning that return. Reasonable monthly target in a neutral market. 1.5 to 2.5% return if assigned, with a 70, 75, 80% chance of getting that on a consistent basis with double-digit downside protection. Stock can fall 10, 12, 15, 20% in this case before we even have to worry about management or anything else. We are not married to these stocks when you're doing an in-the-money covered call. You're not expecting consistent growth. You're just using the underlying stock that has good fundamentals and technicals as a vehicle to earn 1.5 to 2.5% return on a consistent basis with less rolling and less management because you have an extraordinarily high downside protection. Stock can fall much further before I'm even concerned about having to adjust this 17 call, move it down for more safety or anything along those lines. And as we talked about in the beginning from Way, this approach here, it doesn't have to be your approach, Gary, I understand. It doesn't have to be Way's approach either. But this approach here, I'm not married to Mattel. I used it because it has the return and the protection I wanted to get assigned in 30 days. Monday following Friday's expiration, I'm just going to use that search again to find new positions that match my criteria. And it might not be Mattel. It could be 3 other stocks, 4 other stocks. I'm selling them out for May. 2.5% return if assigned, 75% probability of getting it. Stock can fall 10, 12% before I'm even concerned about having to manage it. It's just a vehicle to get 2.5% return per month. And there's a lot of education I know out there. And Gary had commented to me, and I had another coaching session earlier this week where the customer had mentioned that his broker had said that, no, you would never do in the money. You only do out of the money in that case. You know, why do a covered call and sell in the money? Because it's a vehicle to just get 2 to 3% return with high downside protection. That's it. That is it. Okay, does it work? Hey, well, I'm back on my webinar account now. We're on the William Adama account. And let's just do what we did for David. And we're going to go ahead and go back to January. And I think these were all good months, so it's going to look pretty good too. But we're going to do January following expiration. The Monday after expiration, Gary, was January 19th. And I'm just going to use that basic in the money covered call. Default screen. Again, I apologize if this takes a couple 10, 15 seconds to get going. The tables are loading a lot of data right now, and we're searching through a lot of it. Okay, so we had 129 results. And I just want to check these criteria, not between now and expiration. Good. Nothing I'm going to change here. Just going to leave it as is. But let's take the top 15, and we're sorting by highest downside protection in this case, as we saw before with that default screen. This might take a little bit longer, but I want to calculate group results. And let me jot this down here, Gary. As January 19th. And we're using the monthly, so this will take us to Feb. And of course, let's just, while we're waiting for the results to come in, let's just take a look. Do we have any normal stocks here? Sterling Construction. What stands out? Nothing really. Canadian Solar, that one kind of stands out to me a little bit. Foot Locker, Crocs, okay. But a lot of these are positions I don't know. And this is taking a leap of faith here, Gary. I know that we trust our criteria, but I didn't do any research if I would have traded Donnelly Builders first, although I was contemplating doing that as a married put position. Instead, I did Berry Plastics this week. We'll see how that works out. Okay. So profitable, 73% on the in the monies. Profitability, 11 out of 15 for a 0.5% return. Notice this, let's take the top one. Okay, that doesn't look right. Okay, sorry, that actually would have been a full profit. There's something weird here about the option ask prices. So you see, Donnelly was at 1944. We sold the February 15. February expiration, the stock's at 22. Yeah, we would have been assigned and made 1.1%. Builders First did the same thing. And Hoya, did that go down? No, actually, all three of these are a profit. All four, I'm sorry, it's hard to see, but all four of them are profit. All four of them are above the strike price. It's just at the end of the day, the exchanges put in an ask price that was really zero bid to $5 ask. So it assumed we were buying this back for $250, which is inaccurate. It would have been assigned, we would have made the max profit. All these were profitable. I got to get on the programmers about that a little bit. Okay, so no big deal. Let's do the same fair test. Okay, let's go back to the back testing module. We ran on January 19th. And I know this is a quick window, and I don't even remember what happened in January. Let me use the out of the money covered calls. So our return, I'm going to say, was an average of 1.2%, not the 0.5, because those four positions that were there were all profitable. Similar stocks, though, Hoya, Canadian Solar, VIP Shop, those are the three I recognize from the previous search. This is just the out of the money search. Going deep out of the money to look for what now? Only a 2% downside protection with the potential to make 11.7%. Probabilities are at 25 instead of 75. Let's see what happens between January to February. And this might all be profitable. If it's an up market, they might have all been profitable, just as we saw before. Okay, so it's calculating all of these different ones up to February expiration. So we looked at the in the monies, and I'm pretty sure that was 100% success rate, and I'm giving it an average of 1.2% return, higher downside protection. Not too bad. This is a little bit higher, 14 out of 15, 93%, and of course a 14.1% return. What I'm going to have to do for you later, Gary, is take a deeper look into this, I promise. That might be another presentation we delve deeper into next week. And what I mean by that is I want to go back and look at September in October, and then go into the next 4 months through this January that was extraordinarily successful, as we kind of remember after the election and everything. But I want to see the comparison of these different ones in different month cycles, down months, up months. Then you start to see the advantage of in the money covered calls. This is also why when we talk about the monthly and weekly picks of the day, and you see these options here, and they're all slightly in the money for the weekly or for the monthly, that's not just saying, hey, we prefer weekly over monthly. Ernie tested over various time frames similar stock criteria and said, okay, now that I've found a return that I like, that it meets the targets, trading across different markets, let's go 1% in the money. Let's go at the money, and let's go out of the money. 1 or 2 strikes out of the money, 1 or 2 strikes in the money, just at the money. And long term, the consistent profits that are received using the in the money covered calls up and down markets outperformed the return that was seen at the end of the trading cycle with out of the money and with at the money covered call opportunities. That's why both the weekly picks of the day look for that slightly in the money position with the higher downside protection, is because in his testing cycles that he did for the monthlies and the weeklies, the in the monies over time had a higher ending return than the out of the money and with the at the money. Okay. But again, in the right markets, and I just proved myself wrong, that's fine. January would have been the great time to do out of the money options. Instead of making an average of 1.2% with a 100% success rate, you had about a 93% success rate and an average of a 14% return. Well, I'm going to take care of that for you later this week. We're going to take a look, Gary, at what would happen as we did it in a month such as September, and then October, then November, December, January, and February. We're going to look at the in the money versus the out of the money just to see how they performed and to get a gauge, as we sort of did just now and as we did before also. I just want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. I am not going to be posting a trade on Mattel or on one of those deep in the money covered calls that we looked at for David's question or for Gary's discussion. Even though they looked profitable, I'm not opening any of the out of the money covered call positions. I'm already in a DAR position. I just knew the price, so I used that as an example, but that's as a protective put, an RBA as well. Options involve risk and may not be suitable for all investors. And we talked about some of those risks today and how you can avoid some of those risks. If you liked some of the tools that you saw today, you saw the portfolio tools for evaluating rollout opportunities and adjustments where all the math is done for you. We showed you the couple of the search screens and how you can quickly adjust the criteria for David's discussion, and also using the backtest tools briefly, which you can get on the trial for about 3 months, same as you saw for both Gary and David's discussion. Well, you can test out these tools and more for 14 days completely free. No credit cards required. Just go to powerop.com, put in your first name, last name, and email address. You'll have full access to the site for 14 days. The subscriptions start at just $45 per month at the end of the 14-day trial period. That's for the end-of-day data. We do, of course, offer a small 15, 20-minute delayed service at $65 per month. You can upgrade to real-time and the full access to the historical tools as well, as we saw when I went into my account and we went back in further in time, and we could go back to 2017 and beyond, as you saw for David's question about the volatility not getting us the downside in return that we wanted. Of course, as you saw, we mentioned several of those archived webinars for Vincenzo that you can access under the Options Strategies tab and the Options Concepts tab. Just scroll through those. Or as we did earlier as well, you can go to our YouTube channel, use that search function, search for in the money covered calls, naked put positions, managing naked puts, management, and you'll be able to see different webinars on different strategies that we have available as well. Okay, so Gary did ask, are there historical videos or webinars only available on PowerOptions subscription or on YouTube? No, Gary, the top 5 in a couple of those sections, I believe the concepts, option strategies, and the requested topics, the newest top 5 that are posted there are only available to subscribers. However, there's about 20 to 30 different webinars in each section. Any of the other 20 to 30, minus the top 5, are public. Anyone on a trial or anyone just comes to powerop.com/webinars.asp can take a look. But yes, the only place to find our historical videos, our webinars, are on the Power Options webinars page. You don't need a subscription to see all of them, just the top newest 5. But you can also see them on YouTube, of course. If you just go to the videos link there, you'll be able to see all the various webinars also. But there's the only 2 places that we have available in that case, Gary, where we are posting the webinars on Power Options and the webinars page and on YouTube as well. All right. Well, if anyone thinks of any other questions over the weekend or anytime later on, remember you can send me an email to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers can schedule one of those free coaching sessions I mentioned at any time. Essentially a 40 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have.